Market storm caused by recent developments in Turkey knock the local unit. The rand experiencing its largest one-day fall in over a decade, trading at the weakest levels seen since 2008, briefly touching 15.55 against the greenback before leveling out at 14 rand 55 this morning and moving further still to 14.24. But with geopolitical tensions still rife, Maarten Ackerman, chief economist at Citadel, joins me on the line now to take a closer look at the implications for South Africa. Thanks so much, Maarten, for your time today. So we've had the rand getting caught up in this emerging market drought triggered by what's been playing out in Turkey. What have you made of the extent to which the local unit's been hit and the recovery we've seen thus far?
Yes, good evening, Alicia. I think it just reminded us again that, we're not alone on the southern tip of Africa. We are an emerging market. We're part of that peer group. And unfortunately, we also the most liquid market in that peer group. So when things are positive towards emerging markets, we probably benefit more. But when things are turning like it did over the weekend and it's risk off and investors globally is just selling emerging markets, we probably get a little bit more of the headwinds, so to speak. So yes, the currency did drop quite a bit over the past couple of days. Obviously, Turkey is the core problem at this point in time, but we're second in line. So compared to the other emerging market currencies over the past couple of days, we depreciated quite a bit, but Turkey is definitely still the one that lost the most ground. Some of the recovery just showed again that in the Asian markets, especially over this morning, maybe a bit of an overreaction and a bit of calmness coming through the rest of the day, but we're still sitting north of 14.20 at the end of the day.
Absolutely. Let's hone in on Turkey for a bit, because we have a poor Turkish economic policy to consider on the one hand, and then the country's tensions with Washington to consider on the other. How do you see this playing out? Some suggesting that it's not just a matter of liquidity here, but that, the remedy would be a rate hike by the Turkish central bank. Do you agree?
Yes, I think, the Turkish problem is nothing new. It's been in the pipeline for a couple of months already. They are battling with runaway inflation, very high inflation. Yet the government is very much reluctant to actually hike interest rates, which globally is seen as the medicine for runaway inflation. The argument is to say that, higher interest rates are just benefiting the haves, and it's not really helping the have-nots. But as a problem, they are dealing with some high inflation, and that's weighing in on the currency. So that's the kind of structural issues that they've been dealing with, like I said already, over the past couple of months. But of late, it is actually the increased tension between them and Washington for various reasons, and part of that sanctions that the Trump administration introduced and actually increased over the weekend as well. And it's also about the release of the American priest, pastor, that they're actually keeping at this point in time for terrorist claims against him.
Absolutely. Amidst it all, we've had the dollar's safe haven appeal in vogue, and that appetite likely to continue, especially with the U.S. doing better so from an economic perspective, implying that U.S. monetary policy will continue to tighten. So how much weight would carry trade appeal, still hold in emerging markets, given what's playing out stateside?
Yeah, I think at the moment, we are seeing tension building towards emerging markets. We are getting very much to the late end of the economic cycle globally, so to speak. Developed markets are still doing fairly okay. The US is definitely the winning country there at this point in time in terms of very, very solid economic growth. Last week we saw better than expected inflation coming out of the States. And on that background, you can expect that the interest rate increases is likely to continue in the US, obviously. There might even be a chance that, the Fed needs to hike a little bit more aggressively as what the market is expecting at this point in time. So that implies a stronger dollar. Normally, stronger dollar means less liquidity globally, which implies that, unfortunately, that is a bit of a headwind for all the emerging markets, even if the rest of the environment is healthy for you. Where now suddenly we add to this whole emerging market turmoil of late the Turkey issue, but we also had just a couple of months ago issues in Argentina and in Russia. And we are sitting with China, which is very much linked to other emerging markets, also starting to slow a little bit, given the fact that they are making a decision not to stimulate the economy as much as they did in the past. So unfortunately, it is a couple of ingredients that's coming together that is causing severe headwinds for emerging markets and is probably unlikely to fade away over the medium term. So I do think, Turkey might be the start of a little bit more tension in emerging markets. But even if we get Turkey out of the way, the headwinds are surely picking up for emerging markets altogether.
Amidst the risk aversion, local factors in the background still posing considerable risk. Yes, we may not hold, as much external debt in foreign currency as the likes of Turkey, but South Africa needing to consider its current account deficit and its fiscal deficits, both fairly large compared to our emerging market peers, and that leaving the country highly vulnerable right now. What kind of bearing do you see that having on investors' minds right now?
Yes, you're 100% right. So the fact that we sold off as aggressively as Turkey, or in the top three actually over the past week, that just shows that in terms of financial vulnerability, if you look at things like your budget deficit, your current account deficit, our numbers, despite the fact that we're still investment grade, because we just investment grade, but we pretty much in the same kind of camp compared to Turkey and Brazil. In fact, if you look at some of our debt metrics, you can argue that some of those are even worse than some of those countries. Nevertheless, it just shows that, when international investors are making a decision in terms of risk and return, despite the fact that we're still investment grade, despite the fact that we are seeing very positive developments on the political front, we will unfortunately feel the pain to say, well, if this kind of environment continues, South Africa is one of the countries that's quite financially vulnerable, and that's weighing on our currency and our bond market as a result.
Well, let's leave it there, Maarten. Thanks so much for having us on the line this evening. That, of course, Citadel's chief economist, Maarten Ackerman.